financial service which is provided by a factor which is normally a bank. Now factoring covers financing and collection. So they collect your book debts and receivable which arise from the credit sale. So if I define factoring, factoring is a financial service covering the financing and collection of book debts and receivable arising from credit sale of goods and services, which may be in domestic as well as international markets. So what factor does? He collect your money which is pending from book debts and receivable which you have made credit sale. So any kind of debtors and bills receivable arise from credit sale. Now factor will collect them and help you in collection. So factoring is basically we are providing or we are selling our accounts receivable to a factor. It can be called as sale or it can be called as responsibility transfer. Now why the factor will collect your money? Because factor will get a commission, right? So factoring is a collection in the form of financing and collection. Why financing? Because once you give your book dash to them for collection, they will give the money to you in advance after commission. So factoring is basically a financial service covering the financing and collection of book debts and arising from the credit sale of goods and services. So what a factor basically does, now factor maintains your sales ledger and collection. So he gets the idea from whom to collect the money. So they maintain a proper management information system. So they maintain your ledger and they collect your receivable. Second, they also provide a function of credit control. Credit control means that they assess the credit worthiness of the debtor. Accordingly, they advise you to give credit sales or not. So they also provides you a credit control function. Third, they also provide credit protection. Credit protection is called as without recourse factoring. The factor assumes the credit risk. So normally factoring can be recourse or in recourse factoring, the risk is of the company who has sold the goods to collect. If they do not pay money, you will have to file the case. But if it without recourse, it means that factor is liable because factor gives you money in advance in case the debtor or the person to whom you have sold the goods denied to pay the money. In that case, the case will be filed by the factor because factor is assuming the credit risk, so he demands an extra commission. That commission will be called as del creditor commission. So that comes under credit protection. Then financing of receivable. Normally factor gives you an 80% money in advance. So it's a kind of financing. Next, advisory services. Factor also provides you advisory in the area of production, finance, marketing, machine replacement, etc. So they also provide advisory functions. So if we look at factors, what they does: number one, maintenance of sales ledger; number two, collection; credit control; number 4, credit protection; number 5, financing; number 6, advisory. So they provides a lot many functions as a part of factoring services. Now if we look at mechanics of factoring, look at the diagram, right? The goods are sold on credit to the customer. As a result, customer gives you a money later on, but a invoice is generated. So goods are given to customer. As a result, client has invoice. Now client has given this invoice copy to factor. Now factor will collect money from customer, but factor will give you 80 to 90% money initially and balance money on collection. But factor needs only commission, right? So we have a full-fledged mechanics between customer, client and factor. Now if I put into word by word, so step 1: as soon as we receive the order from the buyer, the seller approach the factor to have a factoring relationship, so that factor should know to whom the goods are sold on credit, right? So on receiving orders but before supply, seller approach to buyer, seller approach to factor, saying that this is the buyer to whom we are selling goods on credit. Sometimes these steps can be omitted, so the seller approach to factor even after sale. But if we can approach before sale, we can approach after sale. Number 2, based upon the information given by the client means seller, the factor decides how much factoring service he can provide, because he assess the credit risk, and based upon credit risk he will tell you what is the kind of service he can provide and up to what extent. Third, before deciding whether factor assess the credit credential of the buyer, then he decides he will go for recourse or without recourse. Once these terms and conditions are settled down, now goods are sold by seller to buyer. Once goods are sold, invoice is given by client to the factor for collection. Now once you give the invoice, now factor give you 80 to 90% money in advance and balance on collection. Now factor will inform or will ask the customer to pay money when the time comes. So this is the basic process or mechanics of factoring. There are no fixed steps for factoring, but we understand that this is a relationship between three parties: number 1, client; number 2, customer; and number 3 is factor. So that is a factoring or factoring mechanics. Let's go for types of factoring. If we go for types of factoring, number 1, full factoring. Full factoring is also called as without recourse factoring. This is classical form of factoring. Now under this factoring, what is being done? Factor provides the services like maintenance of sales ledger, collection, credit control, credit protection and financing. So all kind of services which we have just now read out or understand, that comes into your full factoring. But for full factoring he will get a charge for what? As a commission for administration, collection. Now for protection he asks for premium because he's taking a risk, called as del credit commission. So number 1 type of factoring is full factoring or called as without recourse factoring. Now let's come to recourse factoring. Now, under recourse factoring, no doubt, sales is administered by the factor. He also provides you services, but factor assumes no credit risk. So there is no credit protection. Credit control is there, services are there, but risk is assumed by the client. In case the customer doesn't pay money, we will ask to client pay our money back. Factor will not file a case against the particular customer, right? So they will not take any kind of extra commission. Sometime recourse factoring can also have a concept called as refactoring charges. Under refactoring charges, what happen? It is happening only when the client requests the factor not to reassign the invoice and to continue recovery efforts, including legal proceedings. So, not like without recourse, but the client may request to factor, you may have to file a case against the customer. For that purpose, they will take refactoring charges. So one is full factoring, second is recourse factoring. Now third kind of factoring is your maturity factoring. Now, if I talk about maturity factoring, it is called as collection factoring. Now, under maturity factoring, the factor provides sales ledger administration. They provides collection service, but again, like recourse factoring, no credit risk to the factor. But under maturity factoring is done only when the factor collect the money on the agreed maturity date. Right, maturity date is decided upon at the commencement of the factoring arrangement, so that the money can be collected at a easier stage by the factor. So a very minor difference between recourse factoring, it's a mutual date between buyer and seller. But under maturity factoring, maturity date is between client and the factor. So we have full factoring. Number two, we have recourse factoring. Number three, we have maturity factoring. Number four, we have credit factoring. Now, if I go for credit factoring, it is also known as invoice discounting. Under this arrangement, the factor purchases the invoices at discount. The factor neither maintains sales ledger nor undertakes the debt collection. It only provides finance. Now, what does? Debts are assigned to factor, but client maintains the ledger. Customers are notified not of this kind of arrangement. Customer doesn't know we have any kind of factoring arrangement. Of course, factor gets a copy of the invoice. Debt collection is organized by the client who makes over the payment to the factor. Factor maintains the debtors list. Now, factors charges vary the range of service provided to the client. So, under credit factoring, it's very simple. He will not maintain any ledger and he will not collect money. He gives the money in advance at discount. Later on, when the customer gives the money, customer give money directly to the factor. So, factor rather than getting commission, he will pay less money to the client and get a discount. So it is almost the previous form, but it is not actually a collection, it is actually a financing, right? So we have understood few concepts like full factoring, like recourse factoring, like maturity factoring, like credit factoring. Similarly, we have bulk factoring. Under bulk factoring, it is called as invoice discounting. In that case, factor provides the finance to the client only after notification to the debtors to make payment to factor. So under this, customer is prior informed you have to make payment directly to the factor. As a resultant, advance money is given by factor to the client. So called as bulk factoring. Next is your agency factoring. Under this arrangement, factor provides prepayment facility and protection against bad debts. So under this, client carries out sales ledger administration, collection, credit control. Thus, it amounts to almost all kind of services which are already given. So, under agency factoring, almost the same work is being done as was in without recourse. But again, sales ledger is administered by the client, not factor. So this is a slight difference between without recourse factoring or full factoring to agency factoring. So we have various types of factoring like full factoring, like recourse factoring, like majority factoring, credit factoring, bulk factoring, agency factoring, etc. Right. If we talk about the types of factoring we have done, mechanics we have done, features we have done. Now factoring in India. If we talk about factoring in so the done. Right. Before we go for factoring in India, we have one more term called as forfeiting. If we talk about domestic collection, it's called as factoring. If we talk about international collection or beyond the borders collection, it's called as forfeiting. Now, forfeiting is normally without recourse, where the credit risk is assumed by the factor. Now, let's come to factoring in India. If we come to factoring in India comes into picture in 1986 by the chairmanship of committee owned by or chaired by Mr. N. Vegul. What he said, he has given the concept of factoring to solve the problems of finance of small scale industries so that collection is being done. So first committee chaired by N. Vegul. Then we have a committee which is chaired by Sukramoy Chakravorty. Sukhmay Chakravorty has given the concept further increased by giving recourse and recourse. Later on, in 1988, RBI has set up a study group. Now, this study group has given their further guidelines. Study group is under the chairmanship of CS Kalyan Sundaram. So, Kalyan Sundaram committee recommendations are apparently applicable to India. So, we have three-stage development. Number one, chairmanship of N. Vegul, chairmanship of Sukhmay Chakravarti, then chairmanship of Kalyan Sundaram. Now, if we talk about Kalyan Sundaram report, Kalyan Sundaram committee has given a detailed report. What they said few points. Number one, factoring is very much relevant to India. Why? Because we have the requirement of collection. Number two, they said factoring can play a complementary role, meaning thereby they can provide collection and they can also provide financing. Number three, they said with a considerable expertise in bill financing and large network of branches, commercial banks can play a role of factor. Commercial banks have a wide network of branches and facilities, so they can also become a factor. Four, they said there has to be a link between the banks and the clients so that any kind of dispute will not come. Moreover, there has to be a link between the various factoring bodies or various banks so that they know which bank provides what kind of factoring service and to what level so that double financing will not come. So these are few of the recommendations which is given by the Kalyan Sundaram committee. Next, they said small scale units need financing, so for these factoring services has to be provided. Then they said factor need to have fundraising windows like rediscounting. If factor want, they can also rediscount from other bank. Right, they said that even factoring can be done even for international. If you go for international, that will become forfeiting. Then they said there has to be a comprehensive legal framework for guiding factoring services. So what they said, now according to Kalyan Sundaram Committee report, RBI has recommended Banking Regulation Act 1961 has to be amended. Now under this, they have given the guidelines for factoring services. Now, what RBI has said, RBI has said any factoring body which are providing factoring services, they require skills, expertise, infrastructure. Number two, it is like a loan and advance, right? So there has to be capital adequacy with the factor. Number three, it can be recourse or non-recourse. Then RBI has given guidelines for income recognition of the particular client, asset classification, type of client, type of customer. Fourth, a bank exposure through factor financing should not exceed 10% of their total advances, meaning thereby that out of total fund given by bank, factoring cannot be more than 10%. Then factoring should not result into any kind of double financing for receivable. For example, a client get factoring also and a client get discounting also, so double financing need to be avoided. Then banks, factors, clients should exchange information so that every bank know what others are doing to avoid double financing or to avoid any kind of confusion or dispute. Then they said that for the purpose of propagation of bill culture, it may be restricted to receivable finance available from banks, and factor finance has to be monitored by credit monitoring arrangement. The last point says that any kind of bill, any kind of discounting, it has to be properly managed by credit management monitoring, because without monitoring we doesn't know that what is the extent of factoring, what is the relationship of client, customer and factor. So this unit gives us clarity about factoring and forfeiting. Factoring means your how you get collection, administration, management, risk. So these units touch upon various facts about concept of factoring, mechanics of factoring, types of factoring, and how factoring took place in India development. So we have three committees report basically, and Vagul, Sukhmoy, and last is Kalyan Sundaram. Kalyan Sundaram committee report along with RBI modification is presently applicable to India. So this unit clarifies us the factoring concept in detail. Thank you so much.